There you have it, the sound of the closing bell at the New York Stock Exchange. Right now, the Dow Jones spent most of the day in the green. It dipped following Federal Reserve Chair Jerome Powell announcing the Fed's largest interest rate hike in nearly 3 decades. But as you see here, it ended up above 300 points.
That's right. The NASDAQ and S&P 500 both had similar days with significant rebounds following the Fed's announcement. The S&P closed the day up around 1.5%. The tech-heavy NASDAQ is up more than 2.5%. Joining us now for more on this is Matthew Luzzetti. He is a senior economist at Deutsche Bank. Matthew, welcome. Thanks very much for being with us. So how is the Fed's interest rate hike impacting the market today?
Sure. First, thanks so much for having me. As you noted, the market actually took the first 75 basis point rate increase since 1994 rather well today, rallying on the back of it. And I think in part it's a result of a few things. One, Chair Powell in his press conference noted the possibility that the Fed may not raise rates again by 75 basis points at the July meeting. He noted that the decision at that point will likely be between 50 and 75 basis points. And I think more broadly, the Fed, despite raising rates significantly, has maintained a pretty optimistic outlook. They have growth slowing materially, but the unemployment rate only rising to about 4.1% by 2024. So they continue to expect a soft landing and continue to not have a recession over the next several years. And I think the market is responding positively to that.
And it seems the market perhaps factored in that this decision was coming and that it seems pleased with at least the delivery of the messaging. How does, though, raising the interest rate 0.75 of a percentage point help tame inflation, or at least help the Fed do so?
Yeah, so certainly getting this event risk out of the way, I think, is always positive from the market's perspective. The Fed raising rates as aggressively as they are is all about inflation. Chair Powell explained that prior to last Friday's inflation data, both the CPI and the University of Michigan inflation expectations, the Fed had anticipated raising rates by 50 basis points. But after that data came in much more strongly, they decided on a larger rate increase. Ultimately, I think what we've seen in the inflation data is it previously was about supply constraints in goods items, but it's been much more about services items recently, and it's been much more demand-driven. So monetary policy does play an important role here by raising borrowing costs, likely reducing demand in goods and services, and that will hopefully be able to tame inflation pressures over time.
So what does this mean then for Americans? I mean, what kind of difference might they see, in their day-to-day lives at the grocery store, at gas pumps? Will they see any changes?
Sure. So I think the number one thing on people's minds has been inflation. And today's interest rate increase probably doesn't have much of an impact on inflation in the near term. So we are unlikely, I think, to see gas and oil prices fall materially or food prices fall materially in the near term as a result of today's interest rate increase. Beyond that, I think a lot of what we've seen from the Fed has already been reflected in markets. So coming into today, we already saw a 6% mortgage rate in the U.S. So housing costs have already risen substantially. Beyond that, it would be about what happens in equity markets going forward. I think ultimately what we heard from the Fed is they need what we call tighter financial conditions. So they probably need equities to be lower. They need interest rates to be higher. And so looking ahead, that will mean, I think, probably more volatility in markets, but also tighter financial conditions with equities having trouble finding footing and interest rates likely to have to move even higher. So borrowing costs for households moving higher.
So your single phrase summary for how markets did today would be?
Positive, getting beyond the event risk. I think we'll have to see how long this has lived, whether or not we get good or bad inflation data going forward. Our baseline is we will get more hot inflation data. The Fed will have to raise rates by 75 basis points again in July. And ultimately, they're going to have to be more aggressive than they should today over the coming months. But inflation will be the determining factor there.
Positive news for now. We will take it. Matthew Luzzetti, thank you so much, with a gorgeous view of Central Park behind you.
Thank you.